A historic flow of capital is quietly reshaping the global economic landscape. By 2026, trillions of dollars are expected to move from Western economies into China, signaling a structural shift in wealth, influence, and market power. This matters now because the redistribution is not temporary or cyclical. It is driven by systemic imbalances, technological leadership, and strategic positioning. While Western investors seek yield and security, Chinese assets are increasingly capturing long-term inflows across equities, bonds, commodities, and industrial sectors. The implications extend beyond markets. Currency influence, trade leverage, and geopolitical authority are all being realigned. This massive transfer is unfolding without headline crises, yet it establishes a new baseline for global financial dominance. What appears gradual in capital flows masks a fundamental realignment that will shape the next decade of economic power. In the final days of 2025, as global financial markets conclude a year marked by renewed tariff escalations, persistent fiscal expansions in Western economies, and resilient growth in emerging Asia, capital flows are increasingly favoring China, driven by its comparatively higher growth potential, state-coordinated industrial policies, and strategic access to commodities and technology sectors that promise superior risk-adjusted returns. This reallocation is not a fleeting speculative trend but a deliberate institutional shift, where sovereign wealth funds, pension managers, and multinational corporations are channeling resources toward an economy that has demonstrated structural advantages amid global fragmentation. China's gross domestic product is forecasted to expand by 4.8% this year, outpacing the United States' 2.02% growth rate, with Goldman Sachs nudging its estimate upward to 5% for 2025, underpinned by domestic consumption and high-tech investments that contrast with slower expansions in the West. The International Monetary Fund's October 2025 World Economic Outlook projects China's nominal GDP at $19.4 trillion, trailing the U.S. at $30.6 trillion, but closing the gap through productivity gains and policy stability that attract foreign direct investment despite headwinds. Foreign direct investment inflows to China, while declining 10.3% in the first 10 months to 621.93 billion yuan, approximately $86.38 billion, have shown resilience in high-tech sectors, which absorbed 127.87 billion yuan under the 2025 Action Plan for Stabilizing Foreign Investment. Reflecting targeted incentives that bolster strategic industries like semiconductors and renewables. This selective attraction of capital is evident in asset performance, where Chinese stocks have staged a comeback, with the Shanghai Composite Index rebounding strongly after years of weakness, driven by domestic investor confidence and state-backed stimulus measures that have prioritized high-quality growth over speculative bubbles. Western economies, grappling with rising debt levels, such as the U.S. federal debt at $38.4 trillion or 125% of GDP, and policy constraints from interest rate sensitivities have seen slower asset gains, with the S&P 500's performance tempered by tariff uncertainties and fiscal drag. China's state-coordinated industrial policies, exemplified by the Made in China 2025 initiative, have created an environment where capital inflows are channeled towards sectors with predictable backing and high growth potential, such as advanced manufacturing and green technologies. The November 14, 2025, U.S.-China Economic and Security Review Commission report evaluates China's performance under this policy, noting how it has turned the country into a formidable competitor in global manufacturing, with investments in fixed assets showing mixed but resilient trends. A 3.5% decrease in the eastern region offset by a 2.5% increase in the central region from January to August 2025. This coordination allows for targeted capital deployment, attracting institutional investors seeking stability in a world where Western asset performance is increasingly constrained by debt overhangs and political gridlock. For instance, foreign investors remain wary of Beijing's capital controls but are drawn to evolving opportunities, as per CNBC's October 3 report on foreign capital luring amid policy risks, with high-tech FDI rising despite a 27.1% overall decline in 2024. Continuing into 2025 with the new catalog of encouraged industries adding over 200 items to incentivize inflows. The Baker McKenzie's April 2025 Guide on Doing Business in China emphasizes how these policies create a predictable environment for foreign investors, with e-commerce and advanced manufacturing sectors seeing accelerated inflows, contributing to asset outperformance in Shanghai-listed tech stocks compared to Western indices hampered by slower growth. The net effect is a S. Reinforcing cycle of capital attraction where repeated inflows enhance liquidity in domestic markets, strengthen local currency reserves, and compound China's structural advantages. As of mid-2025, China's foreign exchange reserves stood at $3.3433 trillion, providing a buffer that supports yuan internationalization and attracts further investment, with cross-border yuan payments rising 14% to 35 trillion yuan in the first half, per the People's Bank of China data. This liquidity deepening is visible in asset performance, where Chinese bonds and equities have shown resilience, with the CSI 300 index rebounding amid state support, contrasting with Western markets where U.S. Treasury yields on the 10-year note at 4.17% reflect concerns over deficit sustainability, and European bonds face pressures from debt levels averaging 90% of GDP. Institutional allocations are shifting, as sovereign wealth funds and pension managers prioritize China's growth narrative, with foreign direct investment in high-tech sectors under the 2025 catalog drawing 127.87 billion yuan, signaling confidence in state-backed predictability despite broader FDI declines. This cycle is amplified by China's access to strategic commodities, where its dominance in rare earths and battery materials supports asset outperformance in related equities, as Western indices lag due to supply chain dependencies and slower innovation amid fiscal constraints. Geopolitically, this capital favoritism toward China is alarming for Western economies, as it compounds the structural disadvantages stemming from rising debt, global public debt at $111 trillion, and policy constraints that limit return potential, with U.S. growth at 2.02% trailing China's 4.8% per IMF forecasts. Asset performance in 2025 has diverged accordingly, with Chinese high-tech stocks under the Made in China 2025 policy outperforming Western peers, as evaluated in the U.S.-China Economic and Security Review Commission's November report, noting China's formidable position in manufacturing that attracts capital-seeking risk-adjusted growth. The Doing Business in China 2025 guide from Baker McKenzie highlights how foreign investors are drawn to this environment, with incentives lowering thresholds in encouraged industries, fostering inflows despite policy risks. This institutional shift is evident in discussions on X, where recent posts note China's resilience in emerging markets, with capital flows showing strength as U.S. uncertainty reshapes global investment, per FinTech Global's December 22 analysis. Foreign investors eye Chinese tech again, but capital controls weigh, as per CNBC's October 3 report, yet the evolving economy meets proactive policies, drawing inflows to high-tech at 127.87 billion yuan. This self-reinforcing attraction strengthens China's reserves, now at $3.3433 trillion, enhancing its ability to manage risks and attract more capital. The compounding nature of this advantage is visible in fixed assets investment, where China's eastern region saw a 3.5% decrease but central regions grew 2.5% from January to August, per the National Bureau of Statistics, reflecting coordinated policies that sustain growth despite headwinds. Western asset performance lags, with U.S. equities tempered by debt concerns, as the S&P 500's gains are overshadowed by yield pressures from deficits, while Chinese stocks awaken as a sleeping giant, per Erst Asset Management's September 12 blog, driven by domestic confidence. China's FDI trends for 2025 show a 10.3% decline overall but resilience in high-tech, with the first 10 months absorbing 621.93 billion yuan, per China Briefing's November 26 report, signaling strategic sectors attract capital despite broader challenges. The 2025 investment climate statements from the U.S. Department of State note a 27.1% FDI fall in 2024, but 2025's encouraged industries catalog widens incentives, adding over 200 items to stem declines and attract targeted inflows. This positions China to compound advantages as capital flows to its markets enhance liquidity, with yuan payments at 3.17% globally, strengthening reserves and attracting more institutional allocations. Over time, this structural edge erodes Western dominance, as China's performance in assets like high-tech equities, up in Q3 with 4.8% GDP growth per China Briefing's October 23 report, outpaces West's, where U.S. growth at 2.02% lags amid debt at 125% of GDP. The Fed's June 6 note questions China's 5% growth target, but Goldman Sachs' November 21 forecast nudges it to 5%, highlighting resilience that draws capital. China's FDI in Mexico lags U.S. but rises, per Dallas Fed's September 26 report showing strategic positioning that attracts flows. X posts on capital flows to China note resilience in emerging markets, with China's evolving economy luring investors despite controls per FinTech Global's December 22 piece. China's 4.5 trillion flows mark a tipping point in market opening, per Bloomberg's September 10 report, enhancing liquidity and attracting institutional capital. This self-reinforcing cycle positions China as a magnet for growth-seeking capital, compounding advantages over Western markets constrained by debt and policy limits. The alarming undertone for Western economies is the compounding effect, where China's asset performance, high-tech FDI up despite overall declines, signals structural advantages that attract more flows, strengthening its position. China's Q3 2025 key indicators show 4.8% year-on-year growth, with quarterly 1.1% rise, per China Briefing's October 23 report, outpacing US 2.02%. Fixed assets from January to September down 4.5% in East, but up 1.5% in Central, per Stats. Gov.cn's October 21 data, reflecting coordinated policies drawing capital. China's road trip exposes uninvestable Western assets, per Energy Connect's September 21 report, as investors eye its tech despite controls. Understanding China's Q3 indicators shows resilience, attracting flows as Western performance lags amid debt. This shift, with capital favoring China's stability, compounds as liquidity deepens, creating cycles that enhance reserves and influence. Institutional reallocations to China, with high-tech attracting 127.87 billion yuan per Gov. CN's August 12 report reflect this as evolving economy meets proactive policies. China's FDI reviews for 2025 from White and Case note optimized environment reducing restrictions, attracting inflows. Trends in capital flows show China's resilience, per Brookings' November 7 article, as emerging markets diverge. China's 4.5 trillion flows mark tipping point, per Bloomberg's September 10 report, boosting yuan status. This self-reinforcing attraction strengthens China's markets, with asset performance favoring its model over West's debt-constrained growth. The net effect is a structural advantage for China, where capital flows compound, enhancing liquidity and reserves as Western performance reflects policy constraints from debt. China's FDI still attractive, per AMRO's May 26 report, with $116.2 billion in 2024. China's 2025 paradigm of managed liberalization, per FDI China's July 1 blog, balances openness, attracting flows. Tax incentives under 2025 reinvestment policy, per KWM's October 1 report, encourage foreign investors. China's expansion in Mexico investment lags U.S. but rises, per Dallas Fed's September 26 report. This positions China to attract more capital, compounding advantages as West faces slower growth and debt. As capital reallocates, China's performance in assets like stocks and FDI reflects its edge, with Western markets lagging, signaling a shift where institutional flows seek stability and growth in its model. The sleeping giant awakens in Chinese stocks, per Erst AM's September 12 blog, driven by domestic confidence. China's leading innovator in advanced industries, per ITIF's September 16 report, attracts capital. Asset performance management market in China at $1,739.1 million in 2025. Per Grand View Research, projected to $4,442.2 million by 2033, reflects growth attracting flows. This compounding cycle, with capital favoring China, reshapes global allocation, as its stability and assets outperform amid Western constraints. The intelligence assessment indicates this reallocation is institutional, seeking risk-adjusted growth in China's model, with performance reflecting its edge over debt-burdened West. China's economy meets proactive policies drawing foreign investors, per Gov.cn's August 12 report. China's FDI in 2025 first 10 months reveals trends, per China Briefing's November 26 report, with high-tech resilience. China's widening incentive list stems falling inflows, per Reuters' 4 days ago report, adding 200 items. China's catalog encourages foreign investment, per Gov.cn's 4 days ago report, effective February 1, 2026. FDI reviews 2025 note China's optimized environment, per White and Case. Doing Business in China 2025 guide from Baker McKenzie aids investors. This institutional shift compounds China's advantage, as capital flows enhance its markets and reserves, outpacing West. As X posts note, China's repatriation rules for overseas funds tighten capital flows, per Reuters' 6 days ago report, requiring return of raised funds. China's emerging markets resilience in 2025 per FinTech Global's 6 days ago report reshapes flows. This signals capital favoring China's growth, with performance reflecting its model compounding structural advantages over West. The self-reinforcing cycle, with inflows increasing liquidity and reserves, positions China to attract more capital, as its strategic assets in commodities and tech offer higher potential amid Western constraints from debt and slower growth. China's FDI still attractive per AMRO's May 26 report. C. China's 2025 paradigm per FDI China's July 1 blog. Tax incentives 2025 per KWM's October 1 report. China's Mexico investment lags but rises per Dallas Fed's September 26 report. This favors China with asset performance like stocks rebounding per Erst AM's September 12 blog. China's innovator in advanced industries per ITIF's September 16 report. China's APM market at 1,739.1 million in 2025, projected to 4,442.2 million by 2033 per Grand View Research. Road trip exposes Western uninvestable assets per Energy Connect's September 21 report. Understanding China's Q3 indicators per China Briefing's October 23 report. Fixed assets January to September per Stats, Gov.cn's October 21 data, Made in China 2025 evaluation per USCC's November 14 report. Asset allocation secrets for China per Investment Market's October 8 report. Investment in fixed assets January to August per Stats, Gov.cn's September 16 report. This performance edge compounds China's attraction, as capital flows favor its stability and potential over Western constraints. The structural shift in capital allocation, with flows favoring China, is institutional and risk-adjusted, seeking growth in its model amid Western debt burdens. This creates a self-reinforcing cycle, enhancing China's markets and reserves as asset performance reflects its advantages, positioning it to compound influence over time. In the final days of 2025, as global financial markets conclude a year characterized by renewed tariff aggressions, persistent fiscal expansions in Western economies, and resilient growth trajectories in emerging Asia, the movement of approximately $10 trillion in capital flows toward Chinese assets is accelerating a profound diversification away from dollar-denominated instruments, manifesting in alternative reserve accumulation strategies that are reshaping the international monetary order. This wealth transfer, estimated at around $2.7 trillion, set to pass from first-generation creators to heirs across Asia-Pacific by 2030, with a significant portion concentrated in China, is not a speculative frenzy but a deliberate institutional reallocation driven by perceptions of superior risk-adjusted opportunities in a world where Western debt burdens, such as the U.S. national debt reaching $38.4 trillion as of December 5. Equivalent to over 125% of gross domestic product, are constraining policy flexibility and elevating borrowing costs. China's billionaire families, as detailed in the 2025 Huron Rich List, now number 1,434 individuals possessing at least 5 billion renminbi each, setting the stage for the largest wealth transfer in modern history, where heirs step into power amid a domestic economy forecast to grow at 4.8%. Outpacing the United States' 2.02% expansion. This shift is evident in asset performance, where Chinese bonds have maintained stability with the 10-year government bond yield easing to 1.83% on December 26, reflecting a modest 0.01 percentage point decrease from the previous session, while the local currency bond market expanded to 170.9 trillion renminbi in the third quarter, demonstrating robust growth amid controlled capital systems that attract institutional capital seeking predictability. Equities in China have staged a notable rebound, with the Shanghai Composite Index benefiting from state-coordinated policies that prioritize high-quality development, contrasting with Western indices tempered by debt overhangs and policy uncertainties. The broader trend of reducing reliance on dollar-denominated assets is gaining momentum as Western debt levels escalate. Global public debt surpassing $111 trillion, or 94.7% of gross domestic product, and fiscal deficits widen, prompting investors to seek alternatives that preserve value against potential currency depreciation or policy-induced risks. The U.S. dollar index has declined 9% year-to-date as of mid-2025, unwinding gains from previous periods and reflecting cyclical volatility amid structural shifts, as noted in RBC Wealth Management's November 6 analysis, where the dollar's drop through mid-year essentially reversed 2024's appreciation. JP Morgan's insights on the dollar's trajectory in 2025 highlight how consensus growth estimates fell from 2.3% to 1.4% during March and April before partial recovery, yet other regions' stability has drawn capital away from dollar assets. This diversification is institutional in nature, with sovereign funds and pension managers reallocating toward Chinese bonds and equities, where the S&P China Bond Index tracks performance of local currency-denominated government and corporate bonds, providing vehicles for exposure amid a market that has maintained growth momentum. Digital assets in China, though regulated, offer additional avenues, while physical commodities like gold and silver serve as long-term hedges, with gold prices at $4,532.18 per troy ounce on day. December 26 and silver at $79.11 per troy ounce, up 169.63% year-to-date, reflecting investor flight to tangibles amid fiscal concerns. Central banks have ramped up gold buying, with 53 tons in October marking the strongest month of 2025, totaling 634 tons year-to-date, driven by emerging markets seeking to reduce dollar exposure amid U.S. deficits. This gradual shift alters global demand for dollars, affecting treasury yields, foreign exchange liquidity, and U.S. pricing power as marginal reductions in dollar holdings, such as China's treasury divestment to $688.7 billion in October, the lowest since 2008, soften absorption of U.S. issuance exceeding $8.9 trillion this year. The U.S. 10-year Treasury yield stood at 4.14% on December 26, up 0.01 percentage points, reflecting little change but underlying pressure from reduced foreign demand that elevates borrowing costs amid deficits persisting at 5.9% of GDP. Over time, increased exposure to Chinese assets, such as bonds yielding 1.83% on the 10-year government note as of December 26, shifts the equilibrium in international finance, subtly undermining Western dominance as capital seeks refuge in systems with controlled capital and state-backed stability. The S&P China Bond Index tracks this performance, with the local market reaching CNY 1709 trillion in Q3 2025, providing liquidity that attracts institutional inflows amid Western debt concerns. China's bonds, using China 0 quarter 11/25/30, trade at plus 20 to plus 40 basis points over German bunds, signaling emerging risk-free status amid Western uncertainties. The net effect is a strengthening of China's global leverage as wealth transfers, projected at $2.7 trillion to heirs in Asia-Pacific by 2030, with China's great wealth transfer happening now per Bloomberg's November 2 analysis, accelerate diversification that compounds through performance advantages. China's billionaire successors stepping into power, per Jing Daily's report, with 1,434 individuals holding 5 billion RMB each, set the stage for this transfer, enhancing domestic liquidity. Oliver Wyman's September 2025 insights on serving global Chinese wealth note $2.7 trillion transferring by 2030, with global Chinese driving this, strengthening China's leverage as capital favors its markets. Outbound Investments December 16 report on billionaire families transferring trillions notes China's $315.7 billion share, compounding its financial influence. Taipei Times November 6 editorial on China's wealth transfer highlights retirees expecting longevity, facilitating this shift that bolsters China's position. As dollar diversification trends in 2025 show, with the DXY down 9% YTD, investors embrace currency diversification, per Franklin Templeton's August 21 article boosting non-US returns. State Street's August 29 report on diversification in 2025 notes global equities rising as dollar weakens, with China outperforming. Wealth Briefing's December 8 advice to underweight dollar and lean into AI thoughtfully reflects this, favoring diversification amid 2025 trends. This accelerates China's leverage as alternative reserve accumulation through gold. Central banks buying 53 tons in October counters dollar risks. Over time, this wealth transfer compounds China's influence, as asset performance favors its markets amid Western debt, with bonds at 1.83% yield attracting flows while treasuries at 4.14% reflect pressures. Reuters' December 23 report on gold investors notes central bank demand robust amid uncertainties, diversifying from dollar. JP Morgan's December 16 gold forecast sees continuous gains amid trade concerns, reflecting diversification. Central bank's point of gold in 2025 is its reserve roll without strings, per Reddit's discussion. This shift undermines Western dominance as China's alternative accumulation strengthens leverage. The alarming undertone is the gradual nature, where marginal dollar reductions pair with Chinese asset exposure, shifting equilibrium as performance favors China's model. This compounds as inflows increase liquidity, strengthening reserves and attracting more capital, subtly undermining Western dominance while enhancing China's position. In the final days of 2025, as global financial markets conclude a year defined by renewed tariff escalations, persistent fiscal imbalances in Western economies, and resilient growth in emerging Asia, the historic wealth transfer unfolding within China, estimated at over $315.7 billion in mainland China and Hong Kong alone, part of a broader $2.7 trillion shift across the Asia-Pacific by 2030, is not merely a domestic phenomenon but a catalyst for profound strategic consequences that extend beyond finance into the realms of trade relationships, industrial supply chains, and geopolitical positioning. This transfer, driven by the succession of billionaire families and retirees receiving pensions, etc., aiding 6,200 yuan monthly, higher than entry-level salaries for many graduates, is injecting capital into China's domestic industries, bolstering technological advancements and enabling Beijing to exert greater control over critical sectors such as advanced manufacturing and renewable energy. As foreign direct investment inflows to China, while declining 10.3% overall to 621.93 billion yuan in the first 10 months, remain resilient in high-tech sectors attracting 127.87 billion yuan. The influx of domestic and international capital is strengthening China's industrial base, allowing it to dictate terms in regional trade arrangements like the Regional Comprehensive Economic Partnership and the Belt and Road Initiative. This capital surge is reshaping global supply chains, where Western dependence on Chinese production, evident in the U.S. trade deficit with China narrowing to $73.6 billion in exports and $219 billion in imports year-to-date through 2025, grows alongside vulnerabilities to Beijing's policy shifts, such as export controls on rare earths and strategic minerals implemented in October. The financial dimensions of this wealth transfer are accelerating China's emergence as a magnet for institutional capital, where its evolving economy, supported by proactive policies like the 15th Five-Year Plan signaling strategic adaptation for 2026-2030, meets global investors' demand for risk-adjusted growth amid Western slowdowns. China's fixed assets investment from January to September decreased by 4.5% in the eastern region, but increased by 1.5% in the central region, reflecting coordinated regional development that attracts foreign capital despite overall foreign direct investment declines, with the new catalog of encouraged industries adding over 200 items to incentivize inflows into high-tech and e-commerce services. This capital influx is strengthening domestic industries, with China's asset performance management market generating $1,739.1 million in 2025 and projected to reach $4,442.2 million by 2033, driven by advancements in advanced industries where China is rapidly becoming a leading innovator, per the Information Technology and Innovation Foundation's September 16 report. Western economies, facing slower expansion, U.S. growth at 2.02% and G7 averages below 2%, coupled with rising debt levels like Japan's 160% of gross domestic product, are seeing asset performance lag, as highlighted in the Big Picture second quarter 2025 from Franklin Templeton, where deflationary pressures in China persist but sentiment improves with fiscal stimulus contrasting Western constraints. This disparity is enabling China to dictate terms in critical sectors, such as rare earths and antimony, where its dominance in refining, over 90% globally, raises supply chain risks for India's transition, per the World Economic Forum's November insights, forcing Western firms to seek alternatives at higher costs. The U.S.-China Economic and Security Review Commission's November 14 evaluation of Made in China 2025 notes China's formidable peer competitor status in manufacturing, turning it into a leader that reshapes global standards through industrial capacity and technological development. Beyond finance, this wealth transfer is reshaping trade relationships, as capital inflows bolster China's ability to invest billions in Latin America, remaking ports from Santos to Chancay and reshaping grain routes to Asia, squeezing U.S. farmers for decades, per the Arkansas Advocate's December 24 report. China's growing power in Latin America in 2025, unveiling substantial investments and credit lines, has sidelined U.S. influence, with Beijing furious over radical geopolitical changes in the region, per the Hill's December 17 opinion. Trade with China down overall in 2025 for the U.S., with exports decreasing from $93.8 billion to $73.6 billion and imports from $279 billion to $219 billion year-to-date. Per the Carolina Journal's 4 days ago report, highlights how U.S.-China tariff shifts reshape 2025 trade outlook for developing nations, affecting them in complex ways. For the Global Trade Mag's December 17 article, China's rise in global trade with infrastructure influence and implications for Europe, where its overall trade volume surpassed the EU by 14% by 2024, with exports 28% larger, per the Center for Young International Studies' September 15 post, enables it to dictate terms in regional arrangements. The U.S.-China tariff deal's impact on China's growth outlook, per J.P. Morgan's May 20 report, notes China's 5% target unchanged despite talks, allowing it to maintain influence. This trade reshaping increases Western dependence on Chinese production with vulnerability to policy shifts, as 4 ways China-US relations could fracture in 2026. Trade Taiwan supply chains, per Politico's 2 days ago report. 2025 was the why. Year everything changed for the U.S. and China, with China showing it could go toe-to-toe in economic war, per Vox's 6 days ago report. Industrial supply chains are being remade under China's growing influence, as capital inflows enable it to dominate critical sectors like high-tech manufacturing, where foreign investors eye Chinese tech again but capital controls weigh. Per CNBC's October 3 report, yet evolving economy meets proactive policies, drawing inflows to high-tech at 127.87 billion yuan in H1 2025, per Gov. CN's August 12 report. China's economy in H1 2025 GDP, trade FDI highlights, per China Briefing's July 16 report, with fixed assets at 24.87 trillion RMB up 2.8%, show resilience attracting capital. Industrial policy and asset prices from Made in China 2025, per Science Direct, links policy to performance, enabling China to shape chains. China road trip exposes uninvestable assets in West, per Bloomberg's September 22 report, as China's advances make Western startups uncompetitive, halting investments. China's Big Picture Q2 2025 from Franklin Templeton notes deflationary pressures but improving sentiment with stimulus contrasting West. China rapidly becoming leading innovator in advanced industries, per ITIF's September 16 report, enabling it to dictate terms in chains. China's APM market size at 1,739.1 million in 2025, projected to 4,442.2 million by 2033, per Grandview Research, reflects growth strengthening chains. This increases Western dependence with vulnerability to tensions. Geopolitically, the transfer strengthens China's positioning, enabling it to shape standards and alignments, as MERICS top China risks 2025 notes intransigence and defensive measures shielding economy. China's 15th five-year plan signals new phase of adaptation, per WEF's October 30 report. Country report China NOV 2025 from ASEAN Forum notes gaining edge on Russia and improving relations. Deterioration of China's geopolitical environment limits initiative, per Eurasia Review's 6 days ago report, but wealth transfer enhances leverage. China furious over Latin America changes, per Hill's December 17 opinion, as its growing power in region sidelines U.S. Made in China 2025 threat to global trade, per CFR. China's 2025 White Paper on Maritime Strategy, per CSIS's August 19 report, shows growing focus on rights. Geopolitics in 2025 risks opportunities, per Wellington's report. China-U.S. relations 2025, per Max Securities January 16 report, characterized by competition. Shaping stable global future, per CGTN's 1 hour ago report, as China anchors stability. This geopolitical reshaping with wealth transfer interlinked creates ecosystem where China's influence grows.